All right, everybody, we're going to wait another 20 seconds or so for people to filter in, and then we will get started. All right, let's dive in. All right, before we dive in, I want to remind everyone that this webinar is for informational purposes only. We're here to share knowledge about investment strategies, but this is not financial advice. We recommend consulting with a financial advisor or tax professional for guidance on your unique situation. And please remember, all investments carry risks, and past performance does not guarantee future results. All right, now that we got all that legalese out of the way, thanks for understanding, and let's get started. All right, so welcome everybody. Thank you for joining us today. If you're on this webinar today, you likely feel stuck in neutral. Your investment portfolio might be doing okay, but for many of you, whether you've been investing for decades or you are just starting to think about building wealth outside of traditional assets, you're looking around and wondering why others seem to be making strides in their wealth creation journey while you continue to see underwhelming returns that barely outpace inflation. If you've ever felt like your portfolio isn't performing the way that it should, or that your financial advisor isn't telling you the whole story, you're not alone. I hear this frustration all the time from investors just like you. Now, here's the thing. The traditional strategies that many of us have been told to follow, stocks, bonds, index funds, these are all fine in theory. And I absolutely believe in these as a segment of a well-balanced portfolio. But for most investors and advisors, it's all they know. Several studies have shown that the average US investor allocates 80 to 95% of their portfolio to public markets, including stocks, bonds, and mutual funds. Well, here's what I know. If you eat like an average American, you will have an average body. And in that same line of thought, if you invest like the average American, you will have a very average net worth. Portfolios that are primarily comprised of public market investments are far more fragile than you realize. Worse, most financial advisors won't or can't introduce you to the kinds of opportunities that truly move the needle. And that's exactly what we're going to change here today. All right, so for those of you who don't know me, my name is Danny Gould, and I'm the CEO of Gould Capital. Over the years, I've had the privilege of working with investors just like you, people who are serious about growing their wealth and protecting their legacy. And at Gould Capital, we specialize in exclusive investments that most people never even hear about, from commercial real estate syndications in high growth markets to seed round funding in companies like SpaceX. We focus on opportunities that are backed by strong fundamentals, rigorous analysis, and incredible upside potential. These aren't the kinds of deals that you're going to find on public markets or through traditional financial advisors because they don't receive commissions on these types of investments. Now, my journey to this point has been quite unconventional. I started as a pre-med student at Stanford University, and back then I thought my future was in medicine. But life, as it always does, had other plans. And somewhere along the way, during my later college years, I had this unshakable vision and dream to build the biggest, most iconic hotel casino on the Las Vegas Strip. And this dream inevitably led me into the real estate investment world, and it completely changed the direction of my life. This journey has taken me from Silicon Valley real estate, where I drove nearly $500 million in real estate sales, to founding GMS Ventures, a private equity firm with over $300 million in hotels and multifamily real estate assets. Now, that dream of building a hotel on the Strip has forever been my North Star, igniting my passion for private equity and commercial real estate. Now, while actively pursuing this vision, I uncovered a larger mission, one that extends beyond my personal aspirations. I realized that so many investors, especially highly accomplished professionals like yourselves, face a common challenge: a lack of time, access, and knowledge to tap into the kinds of transformative real estate opportunities that can truly build wealth. And that's why I started Gould Capital, to bridge this gap and connect busy professionals with elite passive investment opportunities that are designed to deliver results, whether you're looking for stable passive income, long-term growth, or a combination of both. Today, I'm about to pull back the curtain on the investing secrets that your financial advisor will never share with you, including why traditional markets and equities often underperform and what you can do about it, the alternative investments that can supercharge your portfolio, including commercial real estate and venture capital, and most importantly, how you can align your portfolio with your goals by gaining access to the kinds of opportunities that have been reserved for elite institutional investors and family offices for far too long. And this session is about more than just fixing your portfolio. It's about creating a foundation for one that works as hard as you do. I'm going to share strategies, insights, and real-world examples that have helped countless investors like you rethink their portfolios and achieve results that they didn't even think were possible. But before we dive in, let me make one thing extremely clear. This is not about pie-in-the-sky opportunities or get-rich-quick schemes. At Gould Capital, I really believe in disciplined investing, rigorous analysis, and putting your money to work in ways that make sense for you and for your investment goals. These are proven strategies that have been tried and tested by the top 0.01% of investors for decades. And by the way, everything that I just said right now, you probably deep down inside already knew. It's like this unspoken understanding that there are better investment opportunities out there ready for you to partake in. Yet so many of us fall into the same traps. Let's face it, most of us were taught the same thing about investing. Put your money in a mix of stocks and bonds, hold steady, and let time do its thing. For years, the 60-40 portfolio was the gold standard. It felt safe, reliable, easy to manage. But here's the truth. The market has changed, and so have the rules. Relying solely on stocks and bonds isn't enough anymore, especially if you're serious about building a portfolio that grows, protects your wealth, and gives you peace of mind. Let me explain why. We've always been told that stocks are for growth and bonds are for stability. And that made sense when stocks and bonds worked like a balancing act. If one went down, the other went up. But for the last few years, we've seen something different. Stocks and bonds have started moving in the same direction more often. And unfortunately, that direction has been down. Okay, let's talk about bonds for a second. With rising interest rates, bond prices fall. That's just how the math works. But it's created a tough environment for anyone relying on bonds to stabilize their portfolio. Because instead of being the steady anchor, bonds have been dragging portfolios down to the point at which earlier this year, we saw the lowest diversification, therefore the highest correlation between stocks and bonds in the last 40 years, as you can see on the graph on your screen. So what's the takeaway here? The old playbook didn't work in the way that it used to, all right, folks? Relying on stocks and bonds alone is going to leave you exposed. And frankly, it's not enough to get you to where you want to go. And I do want to take this opportunity to say that this is not a one-size-fits-all approach, okay? What I'm discussing here, what I'm going to be talking about today is definitely not a one-size-fits-all approach. And everything that I've just said up until this point is not a one-size-fits-all approach. There are some people that might truly benefit from a 60-40 portfolio breakdown, but to be honest with you, that is a very risk-averse and generally a slow-growing strategy. And if we want moderate to high growth with moderately low risk, there are a variety of different strategies out there that are going to beat the old 60-40 methodology any day of the week. Now, interestingly enough, most investors I talk to before we start working together basically all say the same thing. Danny, I understand exactly what you're saying, and I know that there are better opportunity vehicles to invest my money into. All right, great. So why aren't we doing it? And it's certainly not for lack of intelligence. Everyone on this call I know is abundantly intelligent and you all have great work ethic. And so why is it that we are stuck? And in my experience, it really boils down to three fundamental hurdles. The first one is time. You are busy. The idea of learning about real estate syndications, venture capital, or other alternative investments can feel overwhelming when your plate is already full. Number two is knowledge. Even if you manage to find the time, alternative investments aren't something that most of us grew up hearing about. They are not covered in the same way as stocks and bonds are, so it's easy to feel like you don't know enough to properly vet these opportunities, and that keeps us from taking action. And finally, the last reason that most investors get stuck is access. And this is really the big one. The best opportunities like private real estate deals or VC rounds, private, early seed funding, these aren't advertised, and they're really shared through exclusive networks and personal relationships and trusted connections. Most financial advisors can't or won't introduce you to them because they're not incentivized to. They don't get paid commissions on these deals, so why would they bring them to you? It's like, they have zero incentive, and so that's why you're not seeing these kinds of opportunities. But here's the thing. If you're not looking beyond stocks and bonds, you're missing out on some of the most exciting opportunities available today. Things like real estate syndications. Now, these offer steady cash flow, potential appreciation, and lower correlation to the stock market. They're a fantastic way to diversify into real estate while building passive income. The second is venture capital. This is where innovation lives. We recently closed a round at SpaceX. We're gearing up for a potential opportunity with Neuralink. These are the kinds of deals that most investors never hear about, but have the potential for significant long-term growth. And finally, other alternatives, including private equity. Private equity is not just for billionaires, okay? Private companies often outperform public markets, especially when chosen carefully. And so being able to invest into private equity funds is absolutely a possibility through alternative investing. And these alternatives are not just about chasing returns, okay? We're not just about getting like the most amount of returns possible. They're about building resilience into your portfolio, and they help you smooth out the ride when traditional markets get bumpy and position you for real growth. Now, I get it. Diving into alternatives can absolutely feel daunting, but that's where I come in. That's where Gould Capital comes in. We've spent years building relationships, doing the heavy lifting on due diligence, opening doors to opportunities that most investors never get access to. We focus on solutions that solve the three barriers that I just mentioned. We save you time by streamlining the process, curating the best deals so that you don't have to wade through the noise. We also make sure to educate our investors every step of the way, making sure you understand exactly what you're investing in and why it works. And finally, through our network, we unlock exclusive opportunities in real estate and VC, deals that you simply aren't going to find anywhere else. The bottom line is the rules of the game are changing, and sticking to the old playbook won't cut it anymore. The good news is you don't have to stay stuck in the status quo. My hope is that this webinar is the gateway to newfound perspective and opportunity. So, how do we get you out of the time knowledge vortex? Most of you understand that taking the time to focus on building your investment portfolio is integral to your long-term success. But let's be honest, as busy professionals, you're so busy making the money, you rarely have time to figure out how to invest it. So what happens? You hire a kid fresh out of college, just past a Series 7 that fits you into a cookie cutter investment strategy that is brokerage spoon-fed to him. I call this the training wheels portfolio trap. Now, what you see here on your screen is a poor kid who just joined Charles Schwab yesterday, just passed the Series 7, and he has no idea what he's doing. And the brokerages give him cookie cutter systems. They do this to absolve themselves of liability. You never fall down with training wheels, right? But the thing is, you're supposed to grow up and eventually take them off. Unfortunately, most people never do. Now, some people eventually stop drinking the Kool-Aid. They find a few gurus on YouTube and decide that the path to financial freedom is through real estate investing. Now, I'm sure that everyone on this webinar is familiar with the traditional approach to real estate investing. You buy a rental, hopefully it cash flows, you save that money and then buy another rental, and so on and so forth. And maybe you amass a portfolio of single family homes, or you then graduate to mid-sized apartment complexes. And for those of you who own a few rental properties already, you understand that this quickly becomes a full-time job to manage these. Even if you have a management company, you still spend a lot of time managing these rentals. And so herein lies the trap. You either don't have the time to learn the rules of the game, or you get sucked into the game to the point where you have no more time to truly scale yourself out. Now, this is one of the most common problems I ran into in my early years in residential sales. Wannabe investors with 1 to 5 investment properties would call me and say that they were done with the headaches. Sell them all, Danny. Sell them all. And I had many investor clients over the years that liquidated portfolios on the come up because they couldn't manage their full-time job plus the job of managing all of these rental properties. And as busy professionals, it can be incredibly challenging to find the time to learn effective real estate investing strategies and actually implement the myriad of real estate investing strategies out there. So, those people, kudos to them. They got way further than most people do. And the truth is if I had known what I know today back then, I would have been able to help a lot of those investors, because inevitably what I could have told them back then and what I'm about to tell you is that there are strategies that exist where you can invest in real estate, take full advantage of all of the benefits of real estate without any of the headaches of the traditional rental strategies. And welcome to the wonderful world of real estate funds and syndications, which is what we will be discussing today. Now, look at these buildings. Okay? Have you ever wondered how these buildings get built? You're probably thinking, oh, maybe some billionaire just decides, hey, I want to buy a trophy property, opens up his briefcase full of cash and just makes it happen. Right? So maybe like 0.00001% of the time that's the case. But the rest of the time, it's people like you and me coming together to collectively invest in these large commercial buildings via syndications and funds. And I may have just thrown out some very big fancy words. So let's break down these different investment vehicles. And to do that, we're going to start by reviewing how these deals are structured. First is the limited partnership structure. Okay, so this is how all syndications and funds are structured. And it's quite simple. Here you're going to see a breakdown of how a limited partnership or LP structure is used in a real estate transaction. So the general partner, or the GP for short, they organize the deal, right? So they source the deal, they structure the deal, they raise the investor capital, they manage the property or properties, they assume the risk. Usually they sign for the debt, so they assume that risk as well. They manage the risk assumption, and they also execute on the business plan and ultimately the disposition or exit strategy. Okay. Now the limited partner or LP, they're investing the capital, and their risk is limited to the capital that they've contributed. And then ultimately they form an LLC, right? And they, hold on a second. They form an LLC. There we go. All right. And then they ultimately buy the building, right? And you can see here all of the roles and responsibilities of the GP and the LP. All right. Now, same thing applies for a multiple event. So this is just one limited partner, right? LP, GP. But same thing can be said for a multiple LP investment, right? So same thing applies for them. So you're in all of those LPs are investing into the LLC. They're designated as limited partners in the operating agreement. Now, the split, the way that these returns are split is pro rata based on the initial investment. And so here's a good example of, just say like a $2 million equity infusion into a deal. Every person you see here is investing $500,000, which means they each get 25% stake in the LP stake of the deal. Right now, a $2 million investment. This is another, pro rata. You see female on the left there, 250,000. So that's 12.5%. The two in the middle there, it's 500,000, which is 25%. And then 750 for the gal on the right. And that is 37.5% of the LP stake in the deal. Okay. So the LP structure is one of the most common structures in the business world. Okay, it's used in all sorts of investment vehicles, not just real estate. We see this all the time in private equity. Hedge funds are structured with the LP structure. Venture capital is structured like an LP structure. Oil and gas, energy, film and entertainment, believe it or not. These are all limited partnerships. And so the question is, what are real estate syndications? Okay, real estate syndication is simply a limited partnership set up to buy a single piece of real estate. So literally everything that we just saw there is exactly what a syndication is. So you'll see this group of investors, they come together, they buy the larger asset. GP is managing the deal. LPs invest. They enjoy their passive returns, because outside of the initial investment and the initial due diligence that they have to do on the sponsor, which we'll go into in a second. And sponsor is another word for general partner, by the way. I just want to throw that out there. So outside of that initial due diligence, it's really truly passive income. Okay. Now, the GP, you're probably wondering, okay, well, how are the numbers? How is everything split up? Okay. GP is going to take a prorated amount of the cash flows, depreciation, and appreciation, just like the LPs. So the LPs and GPs both take a prorated amount of cash flows, depreciation, and appreciation. And the GP is typically rewarded based on a waterfall structure. Okay, so this is not simple stuff. Okay, guys, and I understand there's going to be a replay after this. I understand if you need like multiple times to kind of like get this, because I know it certainly took me a couple of times to get this. But here you can see a sample of a semi-advanced waterfall structure. the LPs are going to be offered what is called a preferred return, where they capture 100% of the distributions until a certain hurdle rate. In this example, that hurdle rate is 8%. From there, the distributions are going to be shared with the GP 75-25 until we hit a 16% internal rate of return, and then 65-35 until we hit a 20% internal rate of return, and then 50-50 after we eclipse 20%. So as you can see, the GP gets more and more of the returns, it's more and more of the pie as we hit higher hurdle rates of return metrics for the limited partners. So obviously this model is incentivizing the GP to hit outsized returns, and because they get a bigger slice of the pie. So it's going to be a win-win scenario. Now, I just threw out some key terms to be aware of. Whenever you see some of these deals, you're going to hear potentially equity multiplier. And that's simply how much your initial investment has grown by. So if you see a 2x equity multiplier, that means that if you put 100,000 in, at the end of the life of the deal, you are expected to receive $200,000, and that includes the return of principal. So you get your $100,000 back, plus over the life of that deal, you made $100,000 in returns in some way, shape, or form. 3x equity multiplier means same thing. 100,000 investment, you get 300,000 back, which includes the initial $200,000 in profit and $100,000 return of capital. Okay. Internal rate of return. This is the annualized return of an investment, factoring in the timing and the size of the cash flows. This is the most difficult return metric to understand because there's a lot of complex math. And I'm going to actually show you a graph here on the next slide that gives you like a kind of a pretty simplistic overview of what IRR really, how to calculate or how to understand IRR better and conceptualize it better. Cash on cash return is pretty simple. This measures the annual cash flow as a percentage of the initial cash investment. So let's say that every year you're getting $10,000 and you initially invested $100,000. Well, that means your cash on cash returns is 10%, right? 10,000 divided by 100,000, 10%. Okay, awesome. Now we get to IRR, which is difficult to understand. But hopefully this graph makes it a little bit easier. So look at this red line there. The blue line shows actual cash flows. So this is an example of a hotel deal that we did here. And the actual cash flows, IRR 22.15%. So you see the blue line is the actual cash flows. Now, what if, and this is, by the way, this graph was created by ChatGPT. This is an amazing ChatGPT is so awesome. So I said, hey, ChatGPT, let's pretend like there was an even distribution of cash flows every single year, right? So you see like year 7, we get like a lot of cash flow, right? Well, that's because we exited the property at year 7. And so we're getting a lot of money on the back end. Well, what if we just made the cash flow steady? You'll see that actually we got a higher IRR. Now, early weighted, IRR is 47.25%. So that's the yellow line. So what if we get the majority of the cash flows up front? And then finally, late weighted is what if we get almost all the cash flows, actually all the cash flows at year 7. So we get 0 returns until year 7, then we sell it, right? So every way we're actually achieving the same equity multiplier. Okay, so every way we're getting the same return on the money based on the cash that we're receiving at the end of the deal lifetime. But because we're getting the cash at the end, IRR measures how the effectiveness of the cash flow, right? So how much of the cash flow is coming to you earlier versus later. So the earlier you get your principal, or the earlier you get rather the returns in the life cycle of the deal, the higher the IRR, right? And so that's why IRR is like, hey, so a lot of investors, and you'll see some of these deals where there is a full return of principal after year 2 or year 3. Now, these deals tend to be very high IRR deals because you're basically getting all of your money back within a certain period of time, usually like 2 to 3 years, and then you're staying in the deal, but then everything after that is just gravy. So again, I am going way off the rails here, so I'm going to come back because I'm nerding out a little bit. Sorry to get nerdy on you guys, but that is, I love this stuff, and hopefully you've already learned something that you didn't know before. Now, let's move on and let's talk about some of the pros and the cons, right? So what are the pros and cons of real estate syndications? Well, some of the pros: passive income. There's not a lot of work that you need to do once you cut the check. Diversification into larger assets. These are large deals, right? I just talked about that. That hotel deal that you saw right there is a 403 room hotel. Right? So this is a large institutional grade asset that you would never be able to, necessarily invest in on your own, or even with like a few of your friends. Hard to invest in those kinds of deals. Third is hands-off management, right? You're not managing the property. There's tremendous tax benefits. This is one of the unspoken benefits, right? The unspoken, true benefits of real estate investing into these larger deals is that there's a lot of depreciation that is captured that gets passed on to the limited partners. And they can use those to write off passive income. So, any stocks, any dividends, any, crypto gain, capital gains, whatever. You check with your tax advisor, right? I'm not giving you tax advice, but there's a lot of write-offs from these kinds of deals. And if you are really smart with your tax strategy and your spouse is a real estate professional, look up the term. There's tons of, you don't have to be a real estate agent. There's tons of ways to classify as a real estate professional. Now you can offset your ordinary income, right? You can start, wheels are turning now, right? Oh, wow, I can offset my ordinary income too. Yes, you can, if your spouse is a real estate professional. So make sure you talk to your tax advisor, your tax professional. There are lots of crafty loopholes and tax advantages to these deals. And we have people all the time that want to structure the deal in a way where they capture less cash flows, right? So, hey, I want to give up the cash flows and take more depreciation benefits. And you can do that, right? Like if you're bringing a sizable enough investment to the table, there are ways to creatively structure these kinds of syndications. So lots of food for thought there. And then you also get to select your deals, right? So with syndications, funds, you're investing in one time into a fund, and then they're investing the money on your behalf into a variety of different assets. So you don't necessarily get to choose the deals, but with syndications, you get to choose the deals that you're in. Obviously, there's a few cons though. Number one, lack of control. So if you are a control freak and you can't let go of anything, this might not be the right strategy for you, right? Now, hard to see how you would ever be able to control an asset of this size, of the assets of these sizes. One person alone could never control such a large asset, right? It's just, there's too much work. It's truly a multi-person job. Illiquidity. So there is a lockup period. You are usually not going to be able to take any of the money out any of the principal out at any time until the deal has gone through the entire cycle. These are higher risk, right? So I need to put in air quotes risk. These are higher risk because it's complex. And there's also risk with the sponsor, right? So you're kind of trusting the general partner, AKA the sponsor, to carry out the business plan. And so while, if you are not carefully vetting these deals and you are unsure of who you are, quote unquote, getting into bed with, there is a higher risk. Now, if you choose, and we can get into this later, but there are ways to kind of mitigate the risk. And these are things that we are going to talk about later on in this webinar. Having fun yet, everyone? I'm going to take a 30-second water break because I am thirsty. And then, okay, so anyways, let's keep going. Now you understand how these investments function. At least I hope you do, very high level. But the real question is why? Why are alternative investments now becoming the cornerstone for passive investors looking to build wealth? According to Preqin, which is the leading data source for alternative investments, the top 0.01% of investors currently have 40% of their portfolio allocated to alternative investments, and that ratio is expected to climb to 50% in the next 5 years. So why are these investment vehicles so attractive? Okay, well, first off, once you pick the deal and wire the money, it's completely passive, right? So there's no tenants, no toilets, no trash, okay? So when you invest in a syndication, you're not the one renovating the property, right? So if it's a value add and you've got to renovate the property, you're not doing that. There's no leaky faucets, screening tenants, managing the property. That's the sponsor's job. They handle all the day-to-day operations while you sit back, you collect income. And this is why syndications are perfect for people who want their money to work harder without requiring time or effort. Secondly, unlike stocks and bonds, real estate doesn't move in lockstep with the broader market. And so you've got diversification. Public equities and real estate generally are not correlated. And in fact, if you look, there's an interesting study and statistic shows 3 out of the last 5 bear markets, real estate prices have actually gone up. So despite negative stock growth and negative GDP growth in consecutive quarters, we have seen real estate prices actually go up. Now, there's a lot of reasons why that is, but it is a strong hedge against the public markets. And syndications allow you to diversify not just by asset class, but also geographically. So you can invest in properties in different markets with their own unique economic drivers. And that way, even if one market slows down, your overall portfolio remains balanced and resilient. And finally, here's a bonus that most people don't even think about, and that is the tax benefits. Okay, so we just talked about this, right? So I'm not going to dive too much into that again, but I think everyone here probably understands after we just discussed there are some significant tax advantages that you'd want to discuss with your tax professional and your financial advisor. And by the way, one thing that I will say about this is, if you are on this webinar and you are an accredited investor that is going to be investing in these types of opportunities, you do not want to do the Quicken, the QuickBooks thing, right? The Quicken or the what is it, TurboTax, right? Like if you're doing that and you've got that much money to invest, you're doing yourself a disservice, right? Because if you hire a tax professional that understands how to read the tax code, right? Because as my mentor Carl Warden once told me, he said, Danny, there's two ways to look at the tax code. The poor look at the tax code and say, this is the book that shows me how much taxes I'm going to pay, how many taxes I'm going to pay this year. And then the wealthy look at the book and say, this is the book that shows me exactly how I'm never going to pay taxes again, right? So you get to decide. And if you find a tax professional that can read the book the second way, right? Because there's plenty in the first that read it the first way too. So not every tax professional's CPA is created equally, but if you find one that really understands real estate, and they're going to make Uncle Sam sad, like the Uncle Sam here on your screen, right? You see little Uncle Sam he's crying because he's not getting paid any taxes. And if you are smart about your investments and you are smart about your tax strategy, you will make Uncle Sam very, very sad. And that is one of my passions in life, is making sure that people don't pay more than they need to in taxes. Okay, so want to keep more of what you earn, and that's something that I'm very, very passionate about. So, anyways, let's dive into a case study here real quick. So this is going to kind of tie everything together and really show you exactly what I talked about. So in the last screen, or the graph rather that you saw earlier, this is actually the cash flow model for that particular deal. Now you'll see this is for a LP contribution. Okay, this is of $150,000. So the LPs put $150,000. Now a couple things about this deal. You'll see on the cash flow line, you'll see that's the cash flow that investor received. Okay, so 0 returns for the first 2 years. Why? Because it went through a renovation. Okay, and so during the renovation, there was no cash flow. Now, after year 3, we got 10% cash flow. Year 4, we refinanced the property. Okay, and at refinancing, by year 4, we basically achieved a full return of principal. Now we're getting some cash flows, and then at exit, we're getting the lion's share of the returns. Okay, $285,000 for this LP, which is 191% cash on cash return that year. And you'll see what are the total LP contributions? $150,000. Total LP profit, that's $326,000. So what is the equity multiplier on that? That is a 3.17 return on the investment in 7 years. So you triple your money, a little bit more than triple your money in 7 years, and the internal rate of return, 22.15%. So it's a very interesting deal. And here's the thing, right? So here's the thing that I want all of us to remember is not every deal is going to be like this, right? And by the way, there's a ton of risk associated with this deal because, it's a full-fledged renovation, 400 rooms. So this is not something that you would go into banking on that 3x return. Right, you're gonna hope that you can achieve like a moderate return, but obviously hope for the grand slam, right? So hope for pray for the best, but plan for the worst, sort of thing, right? But this is a good example of a institutional grade asset that investors were able to invest in. Now, How to evaluate a real estate syndication deal. Obviously, not all syndications are created equally, and choosing the wrong one can do way more harm than good, which is why understanding how to evaluate them is absolutely critical. So what I'm going to provide you with is a very gross oversimplification of the framework that we use to evaluate every deal, focusing on three key components. The first one is the sponsor, okay? The sponsor is the backbone of any syndication, and it's by far the most important thing to vet before getting into a deal. You've all heard of the jockey versus the horse analogy, right? So a great operator can turn a decent deal into a winner and knows how to navigate turbulent headwinds, but a bad operator is going to destroy even the best opportunities. So here are three simple rules that we live by when vetting general partners. Number one is no first-time sponsors. So experience really matters. We're not here to gamble on a first-time sponsor, and real estate is full of surprises. So you really want someone who's been through a couple of cycles and knows how to navigate these challenges, because anyone can succeed when the market's doing well and when everything's going according to plan. But are you going to pick someone that understands or is capable of navigating turbulence when they're presented with difficult situations? And that's the kind of people that we want to partner with. Second thing that we want to do is make sure that they're bringing in a sizable amount of equity. Okay, so when we look at the total equity infusion into a deal, right, which in other words, down payment, right? So what's the down payment that we're bringing in? Okay, so if the GP is putting 5% in, that's cute. 5% of the equity, right? So of the 100% of the equity, they're only bringing in 5%. That's cute. 10% shows thoughtfulness, and anything more shows conviction. Okay, so we want to see something above a 10% GP contribution, right, to the overall equity. And if they're not bringing in at least that, then they're probably not financially capable to help weather the storms if and when we get to a turbulent time, and that means that we're going to get capital calls, and we don't want that, right? So, anyways, that's a subject for another day. But at the end of the day, we want to make sure that they're bringing at least 10% or more equity to the table. And then finally, audited financials. We want to trust, but we also want to verify. Okay, so a sponsor that's unwilling or unable to provide audited financials is not one that we're going to be willing to trust with investor capital. Transparency is going to be a non-negotiable for us, okay? Second factor to evaluate is the business plan. I can't stress this enough, okay? Great deals are backed by great markets. We want to invest in places with strong economic and demographic tailwinds because that's what sets the foundation for success. Here are the questions that you need to ask about the business plan. Number one, do we believe in the market? Are we investing in markets with real economic growth? Number two, is there a sustainable population growth driving demand for housing and commercial assets? And number three, are there key demand drivers like job creation, infrastructure investment, and business-friendly policies? So we need all three, right? So let me give you an example. Take Salt Lake City, okay? It's a market that we really believe in for certain asset classes. Population growth there is outpacing national averages. Its economic strength is driving a surge in the housing demand. And these are the kinds of fundamentals that we prioritize when evaluating opportunities, because when the market is strong, the deal has a much better chance of succeeding, even in uncertain times. Now, I'll say this time and time again, losers chase hype and trends. Winners are going to focus on the data and invest in markets with long-term resilience and growth. Now, let's talk about the numbers, because this is where so many deals fall apart. Here's the reality. In today's wild west of real estate, okay, everyone's touting returns of 16 to 20% IRR. Plus, it's like 16% plus IRR, usually 20% plus. And that's not always because the deals are great. It's because the numbers have basically been reverse engineered to get there, right? And here's the dirty little secret any operator, like most operators will not tell you. Most operators start with the return. They're like, hey, we need to at least get to like a 22% IRR. Okay, great. Now we're going to work backwards and make the numbers in our pro forma and in our projections fit. It's looked great on paper and it looks great in the spreadsheet, but spreadsheets don't pay bills. And if these projections are based on overly optimistic assumptions, you're taking on way more risk than you realize. So at Gould Capital, we ask a different question. What happens in the worst case scenario? We stress test every deal with tough, realistic questions. Number one, what if occupancy rates drop? What if operating expenses increase? What if interest rates climb higher? We want to see deals that even under the most conservative of assumptions, they still hold up and deliver like a 10 to 12% IRR, even in challenging conditions, where our assumed sales price is maybe lower and interest rates jump higher, because real estate isn't about, figuring out, okay, well, what's the best case scenario, right? Because anyone can dream, but it's really about protecting our downside while capturing the upside. And the winners in today's market are the ones who underwrite conservatively and have the discipline to say no to deals that don't pass these tests. So when you're evaluating a real estate syndication or fund, we want to focus on three things. One, sponsor, business plan, and the numbers. A strong sponsor with skin in the game, a business plan built on solid market fundamentals, and numbers that hold up even in the worst case scenarios. And this is how we protect your capital and set you up for success. Because at the end of the day, you're betting, like I said before, I'll say it again, on the jockey more than the horse. A good and strong sponsor with a proven track record gives you the confidence that this deal is in good hands. And great sponsors, here's the other thing too, right? Great sponsors also have the ability to access and pick better deals. And they also have the ability to underwrite more conservatively. So inevitably, it all comes back to the sponsor, because the sponsor, if they are experienced enough, will be experienced enough to pick better deals. They'll also be experienced enough to underwrite better, right? And so you can see how at the heart of it, the jockey is going to be the most important factor in all of this. So while real estate remains the cornerstone of what we do, I do want to quickly touch on, as we wrap up here, another tool for diversification: venture capital and early seed round investments. So VC uses the same LP structure as real estate syndications, which makes it a very seamless addition to your portfolio. These opportunities allow investors to get in on the ground floor of transformative companies, businesses that are driving innovation in tech, healthcare, and even space exploration. For example, we recently had access to the latest investment round at SpaceX, one of the most exciting companies in the world right now. You guys just saw the spaceship land in the. It was crazy. I mean, that was insane. And while this is not a massive part, this type of investment is not a massive part of our overall strategy because it is higher risk, we do see it as a way to diversify and pursue tremendous growth opportunities when the right deals come along. And that being said, we approach seed round investments with discipline. We never allocate a large percentage of our capital here. But for those of us, especially if you're on this call, you have a longer term horizon, it's a great tool to complement the stability of real estate and add some serious upside potential. So looking forward, we're going to continue to share opportunities as they arise, like Neuralink and others. So for investors that want to explore this path alongside of us, obviously, you're a part of our investor community, you will get access to these exclusive investment opportunities. Okay. Now, before we move on, I want to acknowledge that there is a way broader world of alternative investments beyond real estate and venture capital. And I don't focus on these. Gould Capital, we don't focus on these, but these can be a part of a diversified alternative investment strategy. As I mentioned before, private equity is one. You're investing into a private equity firm that buys businesses and increases the profit margins, and it'll inevitably does some sort of roll up or sell off, and there's tremendous profits in that, and a lot of these private companies tend to be a lot more profitable than public companies. Hedge funds. So, hedge funds, great way to diversify if you're really looking for some serious, upside. And one thing with hedge funds, you really make sure that you believe in the investment thesis of the fund that you're partnering with, right? You really want to audit the investment thesis and make sure that it makes sense to you. Because some of these guys, it's just, they're really smart individuals and they have these creative strategies and ideas. But creativity can sometimes backfire on you when it comes to these types of funds, because what works today might not necessarily work tomorrow, and you hit home run, and then all of a sudden you're striking out every single time and you lose all your money. So hedge funds can be very hit or miss. And then finally crypto, volatile, speculative. Seems like Bitcoin's doing very, very well right now. I am, actively looking at this. It is an interesting strategy that I'm definitely looking into at this point, but it's something worth mentioning as well. And, there's also art. You can invest in art, you can invest, film and entertainment if you're interested in that. I mean, there's just so many ways. Oil, gas. I mean, there's just so many things that you can invest into, right? That are outside of the traditional, S&P 500. And I focus on real estate and VC, seed round funding, because these are backed by strong fundamentals. Usually, in real estate, we're backed by tangible assets and predictable long-term returns. But if these other alternatives align with your goals and risk tolerance, they can complement the more resilient plays in your portfolio. Okay, great. Now that we've covered the benefits of alternative investments, the question is, how do you access these opportunities? And here's the truth. You can absolutely go out to the market, and with enough research, effort, and time, you can find deals to invest into directly. So some of them will work with retail investors like yourselves, but here's the catch. The best deals often come with a few hurdles. First is higher minimum investments. So many top tier sponsors require commitments of $1, $2, even maybe $5 million minimum just to have a seat at the table. So that's number one. High minimums is the first hurdle that a lot of investors come into with direct access or direct investment. Second is unfavorable terms. So, hey, you can absolutely have a seat at the table for $100,000 or $250,000, but the terms are not as favorable if you invest with us versus like $1 million or $2 million or $5 million. And then finally, there's no expert oversight. So you're kind of relying on yourself, right? So this is really the most overlooked risk. When you invest directly, you're really on your own. You're relying entirely on the sponsor's word without a second set of experienced eyes like ours reviewing the deal, reviewing the sponsor's track record or the financials. So this is where Gould Capital comes in. We bridge the gap and provide access to these institutional grade opportunities while passing along the benefits typically reserved for bigger players. This is how we do it. Okay. The way you see here is it's illustrated. We run what is typically called a fund of funds or private equity model, right? So we are pooling together through what is called a special purpose vehicle, right? So we are co-investing alongside of our investors, right? So our investor community. And SPV is just a very fancy word for a special type of LLC that allows us to pool investor capital together and gain access to larger deals. And this structure allows us to negotiate better fees, access exclusive opportunities, and minimize risk for you. So in these sorts of situations, a lot of times if we come in with a larger check size, we can negotiate with the sponsor of the deal, of the GP, and say, listen, because we're bringing in 5 million or 2 million or whatever it is, your acquisition fee was 2%. Now we want it to be 1%. And this is your waterfall structure, but this is our proposal for a revised waterfall structure that's going to inevitably bring the LPs, better returns. So in very simple terms, okay, we pool capital from our investor community to access deals that would otherwise be out of reach. And best of all, our success is tied to yours. So as we are investing alongside of you, we earn when the deal performs, and it ensures that our interests are aligned every step of the way. So by investing alongside of us at Gould Capital, you're going to get the best of both worlds. Exclusive access to high quality investments that were once out of reach, a trusted partner who does the heavy lifting. We vet, we structure, we manage the deals so that you don't have to, and a very clear and transparent structure that aligns our success with yours. Our model is designed to create lifelong investment partners, and our interests are aligned with your goals, whether that's creating passive income, preserving capital, or leaving a legacy. So if you are ready to move beyond cookie cutter investment options and take control of your financial future, I invite you to click the link on your screen to book a 20-minute discovery call with me. As William Arthur Ward once famously said, opportunities are like sunrises. If you wait too long, you miss them. Don't waste another year stuck in underperforming opportunity vehicles. Your portfolio deserves better, you deserve better, and most importantly, your legacy deserves better. Because the best investments don't just grow your portfolio, they define your legacy. Let's build something extraordinary together. Thanks again for joining, and I look forward to meeting you very soon.